G'day and welcome to this week's video. This week we're going to check out the yield trap, and as I've told it, don't get caught by the yield trap. So that's where people focus too heavily on one element, a fundamental element of share investing, but focus too heavily on that. As usual, if you like the video, please subscribe to the channel and share the information with your friends and family if you think it's valuable. So let's get into it. Chasing yield and income is something that I think is very important, but what I believe it shouldn't be the sole focus when considering an investment. So I fully understand, particularly when I deal with a lot of retirees, that income is what puts the bread and the milk and the butter on the table. So it's not capital growth. Obviously, to use capital growth, we'd need to divest and sell some of those shares in our businesses. So income is king, as we know, but it shouldn't be the sole focus. And what I have seen in the past is where people blindly chase the yield, and I think Telstra is obviously a classic example of that, and I've got a good case study further on in the video, where always had an extremely high yield, and sometimes what Telstra would do, they would pay out 100% of their profit as a dividend, and sometimes they would even borrow money to make sure that dividend was maintained from one year to the next. So that really covers off that area there, where they're paying out all of their profit as a dividend, obviously to make it very attractive for people chasing dividends. But it is just an abstract number. The income amount divided by the share price gives you the yield, but it doesn't tell you the whole picture about it, the future prospects for a business. It doesn't tell you anything about reinvesting back into the business, and these are extremely important things. So it's only one small part when evaluating a business. So let's go and do compare the pair, and clearly I've got a very low yielding CSL business. Obviously it's been one of Australia's best performing businesses, and I've picked one of Australia's worst performing businesses, which some of you might agree from a pure service point of view. When we try to deal with our phone services, they're not always that good, and from an investment point of view, they've been nothing short of pretty ordinary to horrendous. So let's compare, going back 10 years to 2009, $100,000 investment into CSL and $100,000 into Telstra. Now, back then we would have had a dividend from CSL of 70 cents and a dividend yield of 2.2%. And if we have a look at Telstra, they were providing a dividend, obviously over a smaller share price, of 28 cents, but that dividend yield was 8.3%. So if we were purely focusing on dividend to give us the direction about which is the best company, clearly Telstra would have been the pick if that was the only thing we thought about. But you can see here, in that particular year, the earnings per share was 33 cents and the dividend was 28. So they're retaining a paltry 5 cents per share to reinvest back into the business. If we look on the left-hand side of the screen, the earnings per share at CSL was $1.92, and they were paying out, well less than half, only 70 cents. And that obviously shows why we've got such a low dividend. And also we've got the share price here at the top of 36.66. I think that was the end of January in 2009, compared to $3.55. Now for me, the key issue here is this, the difference in the payout ratios, the amount of money out of the profit per share that's paid as a dividend. Here they're nearly paying all of it out. Some years they did. And here we've got CSL that not paying out much at all in terms of percentage. It might be 30-40%. So what happens over 10 years when you're consistently reinvesting back into the business? Sorry about that glitch. So CSL now has a share price of $193.77. The earnings per share has jumped significantly to $4.92. The dividend's gone up substantially. So $1.92 10 years prior is now $4.92, so that's $3 per share in profit growth. A fantastic dividend. and the dividend yield across the initial investment is 6,200. We compare, obviously share price has barely budged, earnings per share down a bit, and dividend has been cut in recent times, and therefore the share price was savaged over the last couple of years from over $6 down to $3. So whilst the dividend on Telstra still looks more impressive than what it does on CSL, the fact that this business has not reinvested in its future, it's mean that it's gone nowhere, apart from other issues around government, I suppose, dictating what they can and can't sell their products for. This business has not reinvested for future growth, and therefore we've actually seen the $100,000 turn into $88,000, and the $100,000 for CSL, who consistently reinvest into their business and get a really good return on that capital of over $500,000, nearly $530,000. So chasing dividends is not something you should focus on solely. It can be part of the story, but as I say to all of my clients, I want a smaller dividend on a growing amount of money rather than a big dividend on a business that is not growing and going nowhere. I'm focused on the next 5, 10 and 30 years for my retiree clients. So thank you for listening. Please subscribe to the channel if you'd like, and that'd be great, and I'll see you at next week's video. Thanks for listening.